Hey everyone, Mark Ferguson with Invest for More. Welcome to another one of my real estate investing videos. Today I'm going to talk about cash flow again. You know I love cash flow, I talk a lot about it, but in this video I'm going to talk about why cash flow is important, but also why it's not the only thing that's important. I don't invest for appreciation, I don't count on it, but it can be an awesome bonus when you invest the right way. So I really want to talk about using cash flow and appreciation and forced equity buildup as well to make a really awesome investment with rentals. So before I get started, as always, make sure you check out investformore.com, sign up for my email list, get notifications when new articles come out. I'm going to write an article about what I'm talking about in this video tomorrow. It'll be coming out tomorrow, which will be Monday, July 11th, something like that. And there's going to be a lot of numbers I'm talking about in this video. So that article will kind of give you an idea of what those numbers are. It might not make a whole lot of sense the whole time while I'm just spouting out numbers with nothing to look at. But it's still going to be interesting. So please stay tuned, watch it. Of course, like it if you think it's interesting. And be sure to subscribe to my YouTube channel if you want to see some more videos. All right. I talk a lot about cash flow and why that's so important when investing in real estate. And before I really get into the whole appreciation thing, the reason I think cash flow is so important is because if you're paying money into a property every month, if it's not making money, it is a huge drain on you financially. It makes it harder to buy new properties because it will make your debt to income ratio worse, make it harder to qualify for loans. Many times people underestimate the repairs, the vacancies, the costs on rentals. So they're really losing a lot more money than they thought they were losing. And when you go to sell a property, there's a lot of selling costs. You have to pay an agent. Maybe the buyer wants closing costs. May have to make some repairs. So it takes a while to build up enough appreciation, equity, to make it worthwhile to hold a rental property that you're losing money on. Now, if you buy rental properties the right way, that's not always the case. But for a lot of people, they just go out there and buy any property they can. They aren't getting a great deal. I'm going to show you why getting a great deal is such an important part of buying rentals. Now, I'm not saying you can't make a good investment buying without cash flow. A lot of people do it. Most of the people I see who do that are in markets that appreciate a ton. Colorado, where I'm at, California, Hawaii, really appreciate a lot. And those investors aren't spending every dime they have into a rental property. You know, a lot of those investors have a lot of cash. They're investing in a lot of different things. And these rental properties that don't bring in cash flow, don't make much money, it's not a drain on them financially. It's something they can handle because they've got other investments, they've got other money. They're not sinking all their eggs into one basket. So think about that when you're buying for purely appreciation, purely hoping the market goes up. It can really get you in trouble, make it tougher to buy more properties. I have many other videos on cash flow, many more articles on my blog, so you can check those out to get more information on that. But the reason why cash flow is not the only thing that's important is seen by my property. So I've got 15 rentals now. I just sold one a couple weeks ago. I did a video about that that you can check out and see why I sold it. But I bought that house for $88,000 in 2012. I sold it for $199,500. I maybe put $15,000 of repairs in it total over the whole time I owned it. Had it rented for $1,250 a month the entire time I owned it to the same tenants. Great property. It's great seeing that cash flow come in every month. But I made, almost $100,000 selling that property. And it would have taken me a very, very long time to make that much money with cash flow. So there's a lot of plays at work on why I made that much money. The market's been awesome. I've got a great deal on the house. And I made repairs to make it worth more as well. But that just kind of shows that there's more to just cash flow with rentals. That cash flow is awesome. The house maybe $400 or $500 a month. But on top of that $400 and $500 a month I was making, I had a $100,000 payday when I sold it, which is awesome. It's cash flow plus appreciation, awesome bonus, and that's why you've got to look at that. I think a lot of people look at just cash flow when they're buying rentals. They go maybe the Midwest, buy really cheap properties that have awesome cash flow. You're buying $30,000 houses, $40,000 houses. They rent for $700, $800 a month, and the numbers look amazing. And you get good cash flow, but the houses never go up in value. And that's not a bad investment. Not saying it's horrible, but having that appreciation, being able to buy below market value, force equity buildup can really increase your wealth, really make your investment so much better. And I'm also not saying that no $30,000, $40,000 houses will go up in value, but there are some areas of the country where, over the history of the U.S., they've kind of stayed in that price range for many, many years, have not moved at all. The chances of them going up are probably pretty slim. Where I'm at in Colorado, you could buy $30,000 or $40,000 houses 5 or 6 years ago. Those houses are now worth $120,000. I wish I would have bought like 100 of those, but I didn't. So I'm not saying you can't make money in those cheaper properties, but it's tougher. Most of the time, they're not going to triple in value like they did here. And it's really hard to finance them as well. So if you buy those properties for cash, hoping to refinance them in a year or two, maybe finance them in bulk, buy 20 of them, it's really hard to find lenders who want to finance really cheap properties. Most of them have kind of a level they want to start at least $50,000 for each property being worth at least $50,000, or even the loan being $50,000. Some companies want the houses worth at least $100,000 before they'll even loan on them. So it's not always easy financing those properties if that is part of your plan. I talked to many investors who run into that problem where with all these $40,000, $30,000 properties, they can't finance them because banks don't want to touch them. So there's some problems with buying those really cheap cash flowing properties. All right, now let's get to my properties, some numbers, what they have done over the last few years to show you what buying below market value and appreciation can do for your net worth. So I'll show you. I actually have notes for this video. Usually I just go off the top of my head. So we'll see if I can interpret my notes very good or not. There's a lot of numbers here, so try and stay with me. Like I said, I'll have an article I write about this. It goes over the same stuff tomorrow. All right, so I have 15 rentals now. I had 16 2 weeks ago. One of those rentals is a turnkey property I bought in Cleveland, which is one of those cheap $40,000 houses I was just talking about. I bought that with my IRA. It was not bought below market value. I don't really count that in these numbers because it wasn't bought the same way I bought every other house. It's kind of an experiment in my IRA. I didn't want my money in the stock market, so I bought a turnkey rental. Things have to be done differently in your IRA when you invest, so I can't buy it personally. It's tough to buy with loans. It can be a little bit tricky, so that's why I did that. But for the 15 properties I bought, my first one was bought in December 2010. They cost me $1.628 million to buy them. That's the purchase price for all of them if you take all 15 properties. I spent about $156,000 on repairs on all those properties. Those properties are now worth about $2.915 million. So that's a pretty hefty increase over 5 years. And really, only one of those is 5 years. Most of those were bought in the last 2 or 3 years. And a lot of that is appreciation. Our market in Colorado has gone crazy. But a lot of that is I got really good deals on them as well. So if I go a little more into the numbers, I did some figuring. If those properties were all worth exactly what they're worth when I bought them, I probably would have had a $475,000 increase in equity as soon as I bought the house. So those houses were worth $475,000 more than I paid them the day I bought them, basically. And that's awesome way to walk into an investment when you can get that much of a gain the first day you invest into something. One reason why I think real estate is so much better than the stock market, because you can buy below market value, create equity by adding bedrooms, making repairs, getting an awesome deal. All right, going back to my numbers here, I've made about $1.131 million increase since I bought my properties. So what I bought them for minus what they're worth now. Pretty awesome investment right there. Plus, if you think about it, I spent money on down payments. When I bought the properties, I put money into them. So basically, I have about $1.5 million of equity in my rental properties when you look at what my loans are now compared to what the properties are worth. Now, if I were to sell those in the open market, I'd have to pay commissions, costs, maybe make a few repairs on properties when tenants moved out. So after figuring for that, I figured I'd have about 1.344 million gain if I sold all my properties right now, took all that cash, and just walked away. Of course, I have to pay taxes on that. I don't know exactly what that number would be, but I'd have to pay quite a bit in taxes if I sold all those at once. Now, how much did those rentals cost me? That's another question, because I put down payments, I made repairs. If you take all my rentals, all 15, I put about $407,000 down on them. So that was the money I put for down payments. However, rental property number 16, the last one I bought, I actually bought for cash. I did that because I wasn't sure if I was going to keep it as a rental or flip it. And I ended up keeping it as a rental, but I bought it with cash, and I'm going to refinance that and get my cash out here this year. But that made that number pretty big, that $407,000, because I paid $92,000 for that house, paid all cash, didn't get a loan. I also had the $156,000 I made in repairs on the properties. So really, I had about $563,000 I had to pay in cash to buy those 15 rentals. That's if you don't count money I took out of them. So I have not spent $563,000 buying those rentals because I've refinanced quite a few of them to take money back out. On my first rental property, I have a line of credit against it for $120,000. I use that for my flipping business. I refied rental property number 2 and number 3 in 2012. Took about $52,000 out for both of those properties. Both of them being refinanced, I got $52,000 out. In 2015, I refinanced number 4 and number 7, got about $100,000 out for both of those properties. So if you take all that, I've actually taken back $272,000 from refinancing my properties. So really, I've invested about $291,000 of my own cash into buying those 15 rental properties. Not bad when you think about, basically, I've invested $300,000 of my own cash to repair these properties. They have increased in value, or I should say they're worth well over $1 million more than what I paid for them. And my equity is about $1.5 million. So that $300,000 has tripled, quadrupled, almost more than that in value in 5 years. So that's a pretty good investment, I would say. Like I said, part of that's appreciation. Part of that was luck on my part for being in a good market. At the same time, I knew at the time I was getting really good deals, that our market would not stay that down like that. A lot of that was buying below market value. I created almost $500,000 in equity by getting really awesome deals on my rentals. And then part of that is just making repairs. Maybe adding a bedroom, doing some other stuff, adding value to those properties to create that equity. So when you look at that, you can see that cash flow is awesome. I love getting, I make probably $7,000, $8,000 a month on my rentals and cash flow. It's a really good number to have coming in every month. That's after maintenance, after vacancies, after paying my property manager. But that doesn't come close to the equity buildup I've had on my rentals, especially when you think about another thing I'm doing this year, which I'm going to refinance 4 more of them, which will be giving me $244,000 back out, meaning I'll have about $50,000 of my own cash invested in these properties, which, obviously if I refinance them taking $244,000 out, I will be increasing my loan amounts, so I won't have quite as much equity, but I'll still have over $1 million of equity in these properties, having invested $50,000 of my own cash and they'll still be cash flowing, close to $7,000 a month. Obviously, refinancing lowers the cash flow because I'll be paying more in monthly payments. But I'm getting 5-year ARMs on these loans, 30-year amortizations, no balloon payments. I'm using my local portfolio lender. They're charging me 4.5% interest rate. So the increase in payments will be about $1,240 on this $244,000 I'm refinancing out. So not a bad deal if you ask me. And for those of you who have paid attention to me, I was thinking of using Jordan Capital to refinance some of my rentals. That completely blew up, completely made me pretty furious about the situation. I had gone through quite a few hoops, waited months, had what I thought was a loan in place to be around 6% for 30-year fixed loans with them, like 75% loan to value. All of a sudden they lost their lender. I didn't even know they're using another lender. I'd already paid for appraisals, and they did not reimburse me anything for appraisals. They just pretty much said, sorry, you're out of luck. We can do 5-year ARMs at 7% if you want, which doesn't make sense to me. So that's why I'm going with my local lender again. I would not recommend Jordan Capital anymore. I know I had said they were good before. I thought they were, but they're not. So, but that shows how appreciation can be a great play with cash flow. So the final question comes to, well, with the market in Colorado so crazy, I'm not buying rentals here anymore. How do I continue to get great cash flow and build appreciation? And that's why I'm looking at different markets. Many markets in California, in Hawaii, in New York, in Colorado, you can't get good cash flow. It's hard to find really good deals. You can still find them, but it's just hard to find that great cash flow. And I really love the cash flow that comes in from rentals. And when prices go up higher and higher and higher, you're putting more and more money down. The returns are dwindling, and it just doesn't feel as good of an investment to me. That's why I'm really looking at Florida, looking at some different markets to start buying rentals in. Do the same thing, get really good deals, really good cash flow, build my wealth up, build that passive income at the same time. Really, the huge advantage of buying rental properties is when you first buy them, getting an awesome deal on them. So you can see that, it wasn't just appreciation that caused this great increase in equity. It was getting great deals as well. So even if you are buying properties without cash flow, hoping with this appreciation gain, try to get good deals on them as well. I talked a lot about that on my blog, a lot about buying below market value, finding great deals, whether it's an REO property, a foreclosure, a short sale, an estate sale, a regular MLS deal, off-market properties. There's so many ways to get great deals. And it really is a key to rentals, to flipping, to making money in real estate. So when you're buying rentals, don't discount appreciation. Don't throw it under the rug. But try to do both. Try to get your cash flow and appreciation and built-in equity. And it really can pay off big time in just a few years, really. Like I said, I'm selling a couple of my rentals to take out some of that huge gain, refinancing some other ones to take out money so I can reinvest that in new markets, reinvest in my flipping business maybe, but I can do a lot with that cash to really keep building, keep getting higher and higher returns on the money I'm making. So, hope that made sense. I know there's a lot of numbers in this video. Like I said, I'll be doing an article that kind of goes through it, but the gist of it is, yes, cash flow is awesome. I invest for cash flow, but appreciation can be awesome as well and be a huge wealth builder, really allow you to jump up, from stage to stage, really build things quickly if you can do things the right way. All right, thank you for watching. Appreciate all the likes and subscriptions. Check out investformore.com. It's where I have all my articles. I got over 400 free articles, my podcast, lots of great resources. Again, it's Mark Ferguson, and have a great day.